now introduce the very special panelists we have for this discussion. We have Mr. Nilesh Shah, Managing Director, Kotak Mahindra Asset Management Company. Huge round of applause for Mr. Nilesh Shah. Thank you so much for taking time out to be with us. We also have somebody who's a couple of other people who are very popular. We have Mr. Deepak Shenoy, founder and CEO of Capitalmind. Huge round of applause for Deepak Shenoy. And Mr. Dhirendra Kumar, CEO of Value Research. Mr. Dhirendra Kumar, thank you so much for taking time out to be with us. Well, I don't need anybody to ask questions about the markets, barring the three gentlemen on this panel who have managed to answer it. I'm guessing Deepak on social media, Dhirendra on social media as well, and Nilesh on every single TV news channel possible. I'm going to begin by asking Nilesh ji, and then I'll come to the rest of you as well. So many questions. What is happening to the Indian markets? We thought the story was only up, and the months from October 2024 till February, really put us in a dark frame of mind. And then came March and a wonderful, fantastic rebound rally. And just when you're about to say rebound rally, the winning streak gets cut short. Are we in a bear market, Nilesh?
I don't think so. We are in the bear market. And, there was a legendary opening batsman called Sunil Gavaskar. Every time he scored a century, he will take a fresh card. And someone asked him, Mr. Gavaskar, why are you taking fresh card after 100 run? You must be seeing ball as a football, not as a cricket ball. And he said, I don't want to lose my wicket. After scoring century, I'm taking fresh card, so I'm resetting my meter at 0. No wonder he ended up becoming the highest run getter in the world in his time, with highest number of centuries and breaking Donald Bradman's record. Now, Sunil Gavaskar was a legend. Unfortunately, हम लोग नहीं हैं. तो मार्केट ने हमें सिखा दिया फ्रेश कार्ड कैसे लेने का. बैक टू बेसिक्स क्यों करना पड़ता है. Market never goes up in one direction. It always goes up as well as down. And many people had forgotten that market में downside भी होता है, valuation भी कोई चीज़ है, and fund manager भी जरूरी है. So this was one nice way of telling buy market, go back to basics. If making money was as easy as it was in last 5 years, all of us would have become billionaire.
Okay, we'll get there. I'm going to probe you more on that, but I'm going to ask the fundamental questions again to Deepak and Dhirendra. Deepak, are we in a bear market? Yes or no?
No, technically because 20% down, I think, universally is acknowledged to be a bear market. We didn't get there, or we got there only very, very marginally in February. And we're back down to, I think, minus 14% from the top on the Nifty. Your stock could be in a bear market, because you may be down 40, 50% and so on. But that is fine, because a bear market is not a bear market because there's an animal. You just have to bear it. Sometimes.
I think that I'll take. It's a big takeaway. Bear market means it's a market to bear with.
So yeah, I mean, in my limited experience, markets do the same thing over and over again. It is people like us who tend to forget. And when I say us, I mean in general. Even people, who are experienced tend to think, oh well, this may last a little bit longer. But then the party will always find a ending point. And you cannot have a party that lasts forever. So at some point you have to go and, the floor has to be cleaned for the next party to start. So at some point, you're just getting this breathing space to do so. I hope we just don't trash the whole, that 60% down and 40% down does not happen. But I think we should expect that once in a while it will happen, and we're in part of that race.
Okay. Sounds like therapy to me. We're all such jangled nerves because of how the markets are. Dhirendra, you've seen a lot of these cycles. There is now people asking questions on social media like, should I pull out of my SIP? Should I pull out of my mutual funds? Are things going to get any better ever? Have we seen the best already? Those are some of the questions that are in the minds of people.
Yeah, these are very natural questions. You investing is a very positive endeavor. You don't put money in the markets or start doing your SIP to lose it 10% in 1 month or 3 months. It is all, for most people who are coming into the market, it's a very aspirational money. They have seen their friends, they have seen their relatives, or they have heard some stories, positive stories, and they have a real life plan. Investing isn't a game, as we generally think. Your child's education might be dependent on that. Your own home, your own retirement, your real life goals. Your upgrading your car could be one such thing. So, small things, big things. So people dislike something going down. And we know that for over any longer time period, 5 years and more, market has not disappointed. And 20 years and more, 25 years and more, or Sensex, 18%, 19% annualized return that you get. The problem is that it is not a 18% yielding fixed deposit. It does not give you 18% every year. Some years it gets you 36%, and other years it gets you 0%. Sometimes it goes down by 50%. So get used to it. If you really want to accumulate something meaningful, just get used to it. It is just that it is sounding little more noisy, because we have, for the first time ever, I've been in the business of looking at mutual funds and investors' behavior for last 34 years. I started in 1991, and I have seen everything every day as part of my job. That I've been in the business of looking at behavior, and never ever in the past I have seen the number of individual investors getting, what Nilesh was saying, that the number of people and the quantum of money coming from new investors is very tiny. But I have never seen that this kind of wave of mutual fund, 25,000 crore being invested every month by lakhs and lakhs of people. It has never been in the past. Investing has always been a seasonal activity. Mr. Mehta came in 1992, and everybody got onto Bahadur Shah Zafar Marg, and there was a lathi charge to invest in Master Gain. Morgan Stanley came, and everybody queued to invest 800 crore in 3 weeks' time. And everybody was disappointed. We have never seen that you earn every day, you earn every month, you save every month, you spend every month. Why not invest every month? And it's on a natural income cycle. And that has started happening, and that has started happening for a very tiny section of our market, of our population. And it is getting facilitated not by fund managers only. It is happening because of the ecosystem. Today it is possible to set up a 250 rupee mandate of, on your UPI app, which will get debited every month. Savings has always been an Indian habit. Investing in the market has not been a habit. Now, because of the ecosystem, it has been enabled. So I think we are in for the first time, we have seen the massive exodus of FIIs, which has been meaningfully counterbalanced by domestic investors' money. We haven't seen the debacle. Last time round, when it happened in 2008, when FIIs were going and there was nobody to counterbalance, market went down by 58% by October 2008. From the peak of the market on 28th or 22nd of January in 2008, it went down by 58%.
Yeah.
So I'm saying that, we are at the beginning of a multi-year bull run.
Okay.
For a variety of things. And, there is another aspect to it. You should not be asking us if people are buying cars, if people are going and doing their shopping, if people are doing their standard activity, and better. If we are sitting here and we are happily go back home, on a public transport, and on the way, you'll be ordering food, doing this, doing that. If there is, if you have a calamity, market collapse or a long bear run will be reflected first. You'll feel it much before it actually happens to your investments.
Okay. That's what I wanted to ask. The other questions on everybody's minds. One is it a bear market or not? Clearly, you've said the fact that what bear? Where bear? You have to bear with the ups and downs of the markets. Nilesh, if I were to ask you, they also ask this, is the worst over? If you were having this conversation same time last year, there was always talk of how overheated Indian stock markets were, froth in the markets, statements about, mid-cap stocks and small-cap stocks being overvalued, the correction coming. October 24, technically speaking, is when this sort of correction began. And looks like March seems like it was the end of that correction. The worst is over. I want to understand, is the worst over?
So, Krishna, in the market, never say never. Anything can happen. Do you have control over which ball the bowler is going to bowl? And especially if bowler is like President Trump, you have no control over it. Geopolitics will change, interest rates, currencies, growth, everything will change. What is in your control is how you are going to play the ball. If it's half volley, go and hit out for 6. If it's Yorker, just save your wicket. I'll give you another example. Sachin Tendulkar is god of cricket. He has scored more than 15,000 runs at an average of 54. He has scored 51 centuries. There is no successful batsman like Tendulkar. What is his strike rate? In 100 balls, he scored only 54 runs. Now, with the talent and skill of Tendulkar, he should have scored 200 runs in 100 balls. But Tendulkar preferred to stay on the pitch to make run, and that's why he made maximum number of centuries, maximum number of runs, one of the highest average in modern day cricket. There was another cricketer called Shahid Afridi. He has the highest strike rate in test match. Of 100 balls he faced, he scored 86 runs. Fatafat marta tha. How many runs he has scored? Only 1700. So you have to take a call. Do you want to stay on the pitch? Then you can be Tendulkar. If you want to go and hit every ball for a 6 like Afridi, your strike rate will be higher, but your total runs will be 1/10 of Tendulkar.
Deepak, and that's the message, isn't it? It's don't go by what happened in the last 1 month, 3 months, 6 months. Think about what happened in the last 30 years, and that will tell you what to do with your investments.
Yeah, I think there is the problem that we have is we look at the market in terms of months, but the times when we actually need this money to work for us is the times of years. We're saving for our kids' education, which is 15 years away. But we will think of what happened last week to determine how much to invest or not to invest. Because every time you make these decisions, somebody told me decisions are like, you get a fixed number of decisions you can make per day. Once you reach a certain number of decisions, after that, any decision you make it's based on mind fog. The more decisions you make, this is why Steve Jobs used to wear black t-shirts, because he didn't have to make that one black,
Decision fatigue.
Decision fatigue. So every time that you're looking at the market and saying, I have to make a decision now whether I want to invest or not, you're wasting one decision that will ruin your day. And then people are making these decisions multiple times in a day. And I'm sorry, but we are in an age of where media has also, created this as a monster.
I'm guessing clearly because of all your experience in portfolio management services, you're getting that many calls from the investors.
Or rather, investors are naturally confused. They're like, should I add more now or should I add more later? Now, my problem is I sound like a broken record every time. Just invest according to when you have money to save. That is when you should invest. Because at some point, you don't need this money right now, you need it in the future. If you need the money right now, please take it out. Because that's the only thing money is for. It is for spending, right? So the difference or the happiness you will feel in 5 years that I invested on that particular day is much lesser than you will feel next week if the market goes up. So you're optimizing for happiness in 1 week rather than an happiness over 5 years, right? And if you ask anybody here, do you think India will be okay in 5 years? Regardless of what Mr. Trump says tomorrow. I think we're more like, we'll figure a way out. We're big, we're growing. Somehow, unless we screw up magnificently, I think India is on its path, and most of us will agree in that India is a path upwards. We from 10-minute delivery, maybe we'll go to 8-minute delivery. And so, we will not go into. We will never deliver you anything within the. So I think if the story of 5 years is more visible than the story of the next 1 or 2 months, and your investment path is 5 years. Sorry, this is old uncle's part of me speaking, but I'm like, just optimize for your happiness in 5 years.
Yeah, fair enough. Dhirendra, the reason why this conversation is happening is because people are right now wondering which asset class should I park my money in for the long term? What will be the one that will give me peace of mind? I mean, look at the rate at which gold prices are going. So many wonder whether you can park money in big chunks in gold. And when it comes to mutual funds, they say, I mean, the common adage is that buy in dips or when it comes to stocks. Are we in a situation where investors, if they want to put in lump sum money at a time like this of so-called quote unquote correction, they can put in lump sums at the same time continue with their SIPs?
This is a very real situation. Somebody might just get an annual bonus, or you just sold a part of your.
We are in appraisal season technically.
Yeah, you might get an annual bonus, and or maybe you got some ancestral inheritance which was sold off, and you got a very sizable amount. These are real life things which I come across many investors, and they face this dilemma that should I invest now or not. One is that I really don't know. One is that on any given for any given investment, the next 5 years is going to be very positive. And is it going to be a great regret if you invest all that money today? If that money is very critical. And for this, I have actually devised a rule for myself which has absolutely no basis in science. What happens is that, I also get my annual bonus, and I spread it over the next 3 months. Because if I don't do it, the moment I invest a meaningful amount of money and next week the market goes down, you normally have this natural instinct, regret. Though it may not be meaningful in the overall scheme of things, that your accumulation could be 100 rupee and you are investing this 3 rupee and you are obsessed about this 3 rupee. And if you invested and it goes down by 10%, your 3 rupee actually becomes 2 rupee 70 paisa. But if I knew it, my 100 rupee goes down by that much, 10%. That fall is 3 times more than what I am going to put. So it really is a meaningless exercise. I think there are 3-4 rules which every investor should follow, because every saver is going to face this dilemma every now and then, which is invest whenever you have the money, disinvest whenever you plan to require this money well beforehand, and any of your goal will be a negotiable or a non-negotiable one. Your child will get into the college on one given day. You tentatively know the month. You tentatively know the first year fee as well. There are things which are negotiable. You want to go on a holiday, you want to buy your house, you can make it plus minus 6 months, 2 years, or be in reasonable preparedness. Real life goals, I think one should approach. There is no basis, there is no specific thumb rule which to be followed. Invest for the long run. Never invest your short-term money in the market. And as about gold, I think, it is having a flight of fancy for the last couple of years for a variety of reasons. In 2006, first ever financialization of gold happened. Before that, you could only have it in physical form or jewelry. Then came financialization, and now governments are beginning to buy it. And then we saw the ETF and a new demand getting created, so you can have it in your demat account. But the underlying thing is that equity, you get ownership. Fixed income, you lend the money. This fellow just sits in your locker. Don't miss that. And it's not a productive asset. It is it's a store of value.
I'm only asking in terms of percentage of returns it's able to give, say over a 1 year to a 3 year period. Is it right now at a stage where it's better than financial products? Nilesh?
So we have bullish view on gold. The central bankers of the world post-Russia-Ukraine invasion have realized that gold is the actual asset they are owning. All other securities kept any part of the world can be seized. Today, Russia put $250 billion in Belgium, $250 billion in Europe, zero money in US. But they were all invested in securities denominated in dollar, yen, euro. And even a small country like Belgium froze their asset. On this $500 billion, whatever interest they are earning, it's going to Ukraine, it's not coming to Russia. Now, undoubtedly, central bankers of the world are realizing that gold is the only asset we own. On dollar, they have written, in God we trust. Effectively, they are saying that in God you should trust. Don't ask America to give money. It's the God who has to give the money. The central bankers of the world are becoming like Indian housewife, buying gold and not selling. The world is not producing enough gold to satisfy demand of both the sets of investors. So undoubtedly gold will go up higher as long as central bank buying remains. But should you put everything in gold? Well, at one point of time we were told by De Beers that diamonds are forever. Now, thanks to lab-grown diamond, natural diamond prices have crashed meaningfully.
Yeah.
Who knows, if gold prices go higher, a lab-grown diamond could come.
Lab-grown gold, you mean?
A lab-grown gold could come, like lab-grown diamond. I have put a Google alert on lab-grown gold. So far, I haven't heard anything. But I'll keep a watch. Never underestimate technology. Never underestimate ingenuity of human intelligence.
Fair enough. The only reason I'm asking about gold, again, Deepak, is that that's where the money goes when there's a lot of volatility and uncertainty. One is to sort of stick with that uncertainty and ride it out over a long period of time. And the other is, how do you calculate, short-term strategies? Forget about 10-year strategies. What about 3-year strategies?
With gold?
With your investments. If for a 3-year strategy, does it make sense for me then to, invest a significant chunk of my money in gold? And with the financialization of gold, is talking about, if it is going to be SIPs, might as well put in an SIP into a gold mutual fund, isn't it?
Well, if you look at the history of gold investments, are there enough periods of 3 years where gold has given you negative returns? The answer is yes. So, in the last decade itself, you've had multiple 3-year periods, overlapping perhaps, but that have given negative returns on a 3-year basis. Remember, gold at some point was $2,000, 2011. Then it was $1,200 in 2014 or 15 or 16 or something like that. And so it had fallen 30 or 40% in dollar terms. It didn't fall so much in rupee terms because the rupee depreciated in that time frame. 2013, the rupee went to 68 and so on. So you had, and plus India put a 15% import duty. So naturally the gold prices in India were 15% higher than the world. So you got that as a flip. So if the gold price fell by 40, 15% duty, 5 or 10% as this thing. So we fell only maybe 10 or 15%. But we did fall 10 or 15%. After 3 years, if you have 10 or 15% less of your money, even if it's invested in gold, will you be unhappy? If you had bought physical gold, you lose 10% the minute you buy it. Physical gold. Because there's some making charge, there's some wastage. I don't know what this concept means. Who wastes gold? But okay, there's some 3% wastage.
Scrappage would be a good idea.
Scrappage or whatever it is. And then there is a difference between the buy price and the sell price. The same guy who sells it to you for 8,600 rupees a gram buys it back from you at 8,300 rupees a gram. Why? I don't know. It's universally accepted. The minute you buy gold, you've lost 10%. It needs to go up by 10% for you to break even. If you're thinking of this to happen over a 3-year period, and inflation is, well, the country's inflation is only about 4.5%. And gold is a hedge against inflation in the long run. You're probably going to get this 10% as just the inflation move itself. So you lose 10% on entry, on physical gold. And 3 years later, you just about recover your investment. Then in 3 years, isn't an FD better? I'm just saying that, you could get a move like this, which we've had in the last 1 year. But or 2 years, but I don't know whether you can bet on this move happening every 1 year or 2 years. Okay. We should perhaps, and remember that India has now reduced the duties.
Correct.
From 15% down to 6, it might come down to 3, considering the world's, or at least India is saying that tariffs are not, we're going to lower tariffs. We might actually, because there's a 6% duty and a 3% GST in India, so 9%, on 1 kg of gold, which is roughly this in gold, less than this, in fact. 9% is of 86 lakh rupees, which is 1 kg of gold, is nearly 8 lakh rupees. No wonder there's so much smuggling coming in from Dubai. There's some daughter of a police inspector or
I knew you were talking. I knew you were just alluding to the latest headlines on the gold
Headlines
smuggling
on
case from Karnataka, from where you come from, actually.
Yes, it's quite startling, but it's not surprising.
Yeah.
Because if my win is 8 lakhs and my loss is once in 15 years, I'll get caught, and then people will forget after 2-3 months.
The reason why I was even discussing this is because, Dhirendra, how should people be careful? One, if they're investing directly in the markets, they should be careful. It's not like you just throw in money and you're going to make money come what may. The other is investing in mutual funds too. Are there certain funds that are better off for you? Is it the right time to avoid mid cap and small cap funds? Do flexi cap funds work better in the long run? If you're looking at an investment horizon of 5 years or 10 years, do flexi cap funds do better? Sectoral funds are there, and would you say then gold MFs are a good idea? So people have to be careful in terms of which MFs that they're putting their money into.
Yeah, like it is, mutual funds are, where they were supposed to, or they were invented to simplify people's life. You can't invest in the market wisely, or, all the principles, or it requires a knowledgeable guy who has the understanding. But then, like most other dimensions of life, you go to choose a car and there's a problem of plenty. So is with soaps, so is with a shampoo.
Mobile phones.
So, you run a program which actually tells you how to choose one, or maybe the supply. So is with mutual fund. But that doesn't mean that, you can't do with a simple solution. There is a simple solution for, 5-6 kind of funds can actually fulfill most investors' life and well and comprehensively. But then it requires, as somebody said that, simplicity is the ultimate sophistication. But it takes many years, decades to actually appreciate it, or to really have the maturity to embrace simplicity. Most long-term investors investing in equity, their needs will be fulfilled by a multi-cap fund, and that's good enough. And maybe one, at most two. Somebody who is in his 40s getting started, maybe investing for next 10 years, beginning his SIP and some periodic investment, maybe a multi-asset fund, because he may not be, because I'll tell you, the real life experiences. I live in Delhi, and I'm in touch with many bureaucrats, and many of them are getting older because they're a little senior to me and they're retiring. And they come with all their superannuation benefits, and they say this has to be invested. And when I come across a 60-year-old bureaucrat who has never invested in the market, it takes me a lot of time to actually, persuade him to invest in an aggressive hybrid fund. Because when I ask them that, what is your income requirement? Post-retirement, they are still rich guys, they will be getting inflation-adjusted pension. So they said that I don't need income, I don't need this. But, it takes me time for them to be persuaded to invest in a market, in an instrument, which can still potentially go down by a couple of percent in many months. And some of them actually choose not to. So it takes time to get used to it. But when it comes to these mutual funds, I think 3-4 kind of funds can be useful. If you have money for a couple of months, consider an ultra short-term bond fund. Money for a few days, liquid fund. A multi-cap fund will do most of your equity investments heavy listing. If you are a first-time conservative investor and little older who will get upset if it goes down by 5% in a month, start with aggressive hybrid or a multi-asset fund. And these 4 kind of funds can actually fulfill all your lifetime goals.
Wow.
And you can ignore the rest. Rest of it is a story.
Index funds?
Index fund is a substitute of your multi-cap fund, but unfortunately, the index funds, we don't, what you come across as an index fund is a Nifty 50 or a Sensex, which is a large cap fund.
Yeah.
And it does not get you enough diversification. If you look at any 10-year period, we are missing the point that most actively managed fund over 10, 15-year period has beaten the index by a modest margin or a handsome margin.
There you go.
But the way index fund is being touted as if it has to really beat the index on a month-on-month basis, on a quarter-on-quarter basis, or year-on-year basis. People don't get up on 1st of January to invest to beat it by 31st of December. That's how it is being computed. That is how it's being compared. But, there are many excuses why people don't invest in market, and one of it is choosing is complex. If that is an objection, by all means invest in an index fund instead of a multi-cap fund, because you will still be able to derive 80% of the benefit that you will derive from participation in equity.
It's better than not participating in it, isn't it? Nilesh, again, it's a question if I ask you, same question I'm asking Dhirendra, what would be your advice to retail investors who are looking to invest money in mutual funds, be it in lump sums or in SIP in a market like this? What would be your advice? What are the kinds of funds that they should choose?
So my advice to every inexperienced retail investor will be, when your physical health is in trouble, you don't go to the chemist, you go to the doctor, share your symptom, and then whatever prescription doctor gives you, follow. Normally doctor will give you 3 days medicine, morning, afternoon, evening. You don't take all the 9 doses at one go and hope to be cured. You follow doctor's prescription. Same thing is true in financial health. Go to an advisor, go to a mutual fund distributor. First, share your risk profile, share your investment goal. Ask him or her to give you prescription for financial health, and then follow it. 2 examples I'll give, which shows why there is a need for someone to guide you. In COVID time, a colleague of mine called up. He was talking to his doctor, and his doctor requested to redeem all his equities and mutual funds to move into fixed deposit. So the colleague said, why don't you speak to Nilesh bhai? I was speaking with the person for the first time. And in COVID, we were worried about our future. What will you tell others? So my request was that let's wait for 3-6 months. Some medicine will come, then we'll see. Doctor didn't listen to me, sold everything around bottom of the market, put money into FD, converted notional loss into real loss. And after 3-4 months, called back again saying that Nilesh bhai, जो market में return 3 महीने में मिला, वो तो FD में 3 साल में नहीं मिलेगा. अब क्या करें? On the other hand, I have never met this lady, a 75-year-old widow. She had earned her money and she was getting some pension, and she got some inheritance from the husband. And in the COVID time, her investment was geared towards bonds, debentures, debt mutual funds, hybrid funds. And she called her broker कि बेटा मेरा सारा पैसा equity में shift कर दे. And the broker was puzzled, saying that माँ जी इतना risk लेंगे? And she said, बेटा ये उम्र में अब risk नहीं लूँगी तो कब लूँगी? And she shifted all the money into equity funds around bottom of the market. Today, her wealth is 3-4 times more than what she had earned over 75 years of her life. And many a times, when we make such statement, तो लोग तालियां नहीं मारते सरदार जी, लोग बोलते हैं नीलेश भाई जिंदगी में पैसा ही सब कुछ थोड़ी है, 75 साल पे तो रिश्तेदारी काम में आती है, पैसे से क्या कम चलेगा. तो let me assure you, in the 75 years of her life, जितने रिलेटिव उसने बनाए थे, आज उसके पास इससे ज़्यादा रिलेटिव है.
But you're still not. I asked you a very specific question. If I, as a retail investor, even if I would speak to my portfolio manager and tell them, please kindly stay away from mid-cap funds, please stay away from small-cap funds. Any pointers that you would like to give?
So I will still recommend go to a good distributor advisor, and suppose if you don't want to go to a third person, then please put money in what is known as multi-asset allocation fund. It's a Harfan-Maula fund which divides between debt, equity, and precious metal like gold and silver. The fund manager takes view on a longer term basis on how much to allocate in which asset class. Industry has many multi-asset allocation fund. And my guess is that 99% of retail investors has underperform multi-asset allocation fund performance over a longer period of time. 1% would definitely outperform that kind of fund. So if you don't want to get into financial planning and share your goals and objectives with a third person, just keep on investing in multi-asset allocation fund whenever you have money. But please give long-term to fund manager. Fund managers are not magicians. They can't generate return in a short term. Give them time. Your dreams, your aspirations, your financial goals will be achieved.
Deepak, would you concur with that? I see strong agreement coming in from both you and Dhirendra. Net, if you were to sum up this discussion for all the doubts and fears in the minds of everybody, go out there, pick a multi-asset allocation fund, put lump sum in it or SIP in it, whichever way you do it, you should be fine. Just forget about that money for the next 5 to 10 years.
Honestly, fund managers will say that, no, because I mean that's you're listening it. You're asking a barber if you want a haircut. It sounds odd, right? But I think it's also a very interesting thing about mutual funds is we have seen that behavior is the driver of investing. Of your investments. You invest because your behavior is in a certain way. Markets are down, you want to invest less, you want to cut SIPs. Your markets are up, you want to increase SIPs. That's natural behavior. And one of the reasons these multi-asset or these hybrid kind of funds work is that if I told you to put 33% of your money in equity, 33% of your money in debt, 33% of your money in gold, there will be times when equity will be doing really well and you will be saying, "Ye debt mein kyun rakh raha hu? Why am I?" And then someday gold will be doing maybe not so well as equity, and you'll say, "Gold ka nikal ke equity, gold kaun khareedta hai? Wo to ghar pe pada hua hai." All these questions are because now you're seeing them as individual parameters. If I said, forget all this, there is one thing that does all them, and it mixes the price. You're getting the appreciation on 33% of equity and 33% of debt and into one NAV. That NAV is not going up by 20% or 25%. It's going up by 12% or 11 or 10%. And when it falls also, it doesn't fall as much as equity because the debt thing cushions you. But you don't see the individual components. So your behavior is different. So if you're a person who reacts to the prices because you act like this is your 10th standard report card every day, honestly,
I'll never forget my 10th standard report card. I used to dread it.
it's a thing that all of us remember and sometimes fear, depending on what you did. But it is actually something that, because the markets give you a report card every day, you feel like you are being tested and you have failed or succeeded every day.
That's because all these portfolio managing services, they give you this app, and the app has a pie chart, and then there are colors on it. And when you see red on it, you are like, okay, my day hasn't begun the right way.
There is this option in some new Android phones which says, remove all the color on my phone. It's only black and white. So you can't see this red and green anymore. Therefore, you perhaps react much lesser. Apparently, it's healthier. And I think it's healthier in the markets to A, open your apps less often, and B, to make it black and white, which may be an interesting way for you to not react like crazy, because in the end, you're only looking at some grays and hoping they're better than the others. Yeah.
Right. Life exists in shades of grey. I'm going to take one last quick comment from Dhirendra because we're completely out of time here. Dhirendra, one simple line of advice to all those watching this, for all those who sort of found ways to stop their SIPs or take money out of mutual funds and are sitting on the fence right now, wondering, looking up at the skies, going, Bhagwan, kya hone wala hai?
All I can say is don't do that. Because, you'll be depriving yourself. In fact, this multi-asset hybrid and all these things, there is one very nuanced, thing which has come about. Equity investing was, all the returns were tax-free not very long ago. Now, every time you have gains, you want to rebalance it, you want to move, assuming that you choose to invest 50% of your money into equity, 50% into debt. And every time one thing became 60, you changed it, reset it to 50. What happens is every time you have a 10% gain, it gets reduced by 12.5%, which is the long-term gains, assuming you held it for 1 year and more. So when you entrust it to a fund manager, he does all that. And you are not liable for that. So this is a great, keep it simple. Choose 1 or 2 funds. Start investing. Don't fiddle with it. And for first 2-3 years, don't open your app. Just open it to make investment. You have nothing to lose while you are still accumulating. Worry about it after 3-4 years if you need to apply some rules.
I couldn't, loud and clear. The message is very, very loud and clear. Don't fiddle with it. Don't look at your apps all the time. Reduce screen time. I mean, the whole point is that we are supposed to all reduce our screen times on our phones either way. Start by reducing the number of times you look at your investment app and seeing whether it's going up or down. Clear message coming in from this entire panel. Keep investing, stay invested, and don't expect magic, because neither are fund managers magicians, nor are you. So keep it simple and keep it consistent. That's the message coming in. I'm going to wrap things up on that front. I'm going to ask for a huge round of applause for the wonderful panelists we had for the discussion, who could not make it any clearer for us. Thank you, Nilesh Shah. Thank you, Dhirendra Kumar. And thank you, Deepak Shenoy, for being with us and putting this in such simple terms for us. And, more than all those watching, I got a huge piece of advice of what I need to do with my own portfolio as well. Thank you so much for doing that. And thank you for the huge applause for the audience inside the room over here. Huge